Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, today I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, February 23rd at 2 p.m. in London. In theory, investing in corporate securities like stocks or corporate bonds should be about, well, the performance of those companies. But since the outbreak of COVID in 2020, financial markets have often felt driven by other higher powers. The last several years have seen a number of big picture questions in focus. How fast could the economy recover? How much quantitative easing or quantitative tightening would we see? Would high inflation eventually moderate? And more recently, when would central banks stop hiking rates and start to cut? All of these are important big picture questions. But you can see where a self-styled investor may feel a little frustrated. None of those debates really concerns the underlying performance of a company and the factors that might distinguish a good operator from a bad one. If you've shared this frustration, we have some good news. While these big picture debates may still dominate the headlines, underlying performance is starting to tell a different story. We're seeing an unusual amount of dispersion between individual equities and credits. It is becoming a market of many. We see this in so-called pairwise correlation, or the average correlation between any two stocks in an equity index. Globally, that's been unusually low relative to the last 15 years. Notably, options markets are implying that this remains the case. We see this in credit, where solid overall performance has occurred alongside significant dispersion by sector, maturity, and individual issuer, especially in telecom, media, and technology. We see this within equities, where my colleague Mike Wilson, Morgan Stanley's CIO and chief U.S. equity strategist, notes that the S&P 500 and global stocks more broadly have decoupled from Federal Reserve rate expectations. And we see this in performance. More dispersion between stocks and credit would, in theory, create a better environment for active managers who attempt to pick those winners and losers. And that's what we've seen. Per my colleagues in Morgan Stanley Investment Management, January 2024 was the best month for active management since 2007. The post-COVID period is often felt dominated by large macro debates, but more recently, things have been changing. Individual securities are diverging from one another and moving with unusual independence. That creates its own challenges, of course, but it also suggests a market where picking the right names can be rewarded. And we think that will be music to many investors' ears. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.